Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Hump Day. It's Wednesday, March 15, also known as Fed Day. We'll get into that in a minute here, but we've got a lot of data to go over, so we'll just jump right into it. We'll start with the Consumer Price Index, also known as the CPI. This is a consumer-based inflation index, which kind of helps us get a good gauge as to where things are moving. If income are going up, if there's prices are going up. So back in January, we had a huge number here. It went up 0.6%, and it dropped in February. So we had a forecast 0.1, and it came in at 0.1. And a lot of that is due to the lower oil prices, or in turn of gasoline and stuff. So that kind of helped us out here. Now, when you strip out food and energy, we get what they call the core CPI, and this is really kind of what they look more at because the volatility that food and energy presents. So back in January, we had a 0.3% increase. Forecast for February was coming in at 0.2%, and came in at 0.2%. So it came in as forecast. So it came in pretty decent. So not too high of a number, which is a good sign for us, especially in a rising rate environment here. Now, one of the reasons why they do raise interest rates is to keep inflation in check. Now, the Fed looks at this, but more important, more heavyweight in terms for gauge for inflation is the PCE, or personal consumption expenditure. So they look at this, and it has a lot of weight to it, but they look more heavily at the PCE, core inflation, on that one. Also on the news, we got retail sales. A lot of these are all important. So data here. So retail sales is a big one here. January had a pretty big number at 0.6% increase. Forecast for February was at 0.1 and came in 0.1%. So not as good of a number right there. Now, when you take out the big ticket items like autos, we get the retail excluding the autos. We had a pretty big jump in January at 1.2%, and forecast was supposed to be 0.1%. Came in a little bit higher at 0.2%. So okay number, especially for February, considering that January typically you get the after sales from Christmas or the holidays. People buy, take advantage of the sales here, and then February gets kind of slow down until probably like the second quarter when you start getting into the summer and stuff. Empire State Index. This is a manufacturing number in the New York region. Anything above zero is considered expansion. Anything below, of course, is contraction. So we had a 18.7 on the number here for month of February, and it dipped a little bit down to 16.4. Now, decent number. Come in mind, it is a decent number here, but it did dip a little bit. So something, of course, we want to see if that becomes a trend or if it's going to pick up. It may be due to the weather in New York, especially this past week. There's been some pretty bad snowstorms hitting there, I think, the last day or two. Home Builders Index. This is kind of the confidence level for home builders. Important gauge, as you can see, back in February, it was at 65, and an increase in March. So there's been some Trump, I guess, is kind of supporting them a little bit with some of the regulations on permits and stuff, helping them out with the deregulations, and that's kind of boosting their confidence level, which could also help with the inventory level. We're at a very low inventory level here in the U.S., which is help driving homes prices. Because there's a lot of demand, but there's no inventory, and this might help us out with home builders who building brand new homes and stuff and create more inventory for the consumers. We also got business inventories for the month of January. So back in December, we had a 0.4% increase of business inventories, and still a decent number in January, a 0.3% increase. So it kind of shows that businesses are feeling a little bit more confident, gaining more inventory, and feeling more confident about where the economy is moving. And last but not least, the big one. We got our big day today, as we mentioned, the Fed day. We got the FOMC announcement. This will be coming out. The rate hike will be announced at 11 o'clock Pacific Standard Time, 2 o'clock East Coast. And around 11:15, Janet Yellen will be giving her announcement. So be prepared for a lot of market volatility. Now, pricing in both markets from stock and bonds are pricing in pretty much a guaranteed rate hike. Everybody expects this over the last week or two, a week and a half. There's been a rate hike this one. Previously, they thought their first rate hike would be in June. Now, from the last meeting, or the last couple meetings really, they kind of insinuated that there will be 3 rate hikes this year. But we've been getting some pretty good numbers here, and there's concerns or speculation that maybe the Fed might may have 4 rate hikes. So the key won't be on the rate hike itself, but more on the statement that should be providing, and seeing and looking at the dot plot map to see as to the pace of the rate hikes, and if it still continued to be 3 for this year, or if it might increase. They want to see if it's a hawkish tone or more of a dovish tone, or somewhere in between. But that's going to what's really be what drives the interest rates. At least drive what's going to happen today here. So expect a lot of volatility later today after the announcement, as they kind of cipher through the meanings and kind of read through the statements and such. So let's go ahead and look at headline news. The kind of stock market's up a little bit. It's priced in the rate hike. Again, they're kind of bracing for the news as to Janet Yellen presents. Bond market's up right now, so we did break above the second floor resistance yesterday, which was a good news for us, because if we remain below it, as we saw here, we broke below the previous one, we kept going down and down and down, so it leaves us more room further, and it creates that trend of worse rates. Now coming up here, now maybe we have a trend reversal. So this comes into question: will we have a trend reversal? We're going up against the first level of floor support. And again, the volatility comes in after the Fed raises rates. So everybody's kind of waiting and seeing as to what the Fed statement will stay. Right now we're up about 9 basis points. Some lenders might come out with better pricing from yesterday, because they may not have given the better pricing yesterday. As when we did this, I think we were just below this, and it improved throughout the day. And a lot of lenders may not have given that price improvement yesterday, and it may come into more today. All right, folks, so better pricing today, and again, a lot of volatility. If you guys want more highlights of statements and stuff like that, come over to Twitter. I do post throughout the day, and you'll get more information, especially about the Fed meeting on Twitter here. Just come over to Mike Bjork and follow me there, and you'll get your updates. Have a wonderful day. Thanks for watching. We'll see you guys tomorrow. Bye-bye.